Hi, now we're going to look at performance reporting and we're going to use some examples. You're probably seeing that not much of the information we're going to go through with you is new, that you've seen it one way or another in previous videos or in previous modules. I recommend that when you're looking at each area, you ask yourself, well, where would you come across when you're working? When could these situations actually happen? Because this focuses your mind and then helps you plan an exam answer. Because that's what the goal of the examiner is, to put you in real life situations to see how you would react. First, let's look at performance reporting for external stakeholders. I'm not going to go through this in great detail for this video because you all should already know the different types of reports. Obviously, there are the ones that are required as part of financial statements, the statutory reports, so the statement of profit and loss, other comprehensive income, the statement of financial position, as well as the other reports such as the director's report. As an accountant and in your exam, which is what we're working towards here, you will also prepare reports on non-statutory reports on the financial or operational performance of the organisation as is when you're needed. Now, previously in the old P2, you completed full questions. Please note that for SBR going forward, it'll be just smaller parts of these longer questions, but you still need to understand the whole consolidation. You must be able to also identify when a report, a memo or a letter or just an email is required, and by now you should have a good idea about what these layouts look like. When you're preparing a report for external stakeholders who may not be financial professionals, you must explain what you're reporting in a simple way. This is a practice skill. Please try and avoid using acronyms. For your exam, I recommend, if you haven't already done so, is download and read the most recent set of financial statements for a large multinational. That way you can see your learning and practice and familiarise yourself with layout, language, and how the reports look. Next we move on to revenue recognition. In financial reporting you looked at IFRS 15, revenue from contracts with customers, and at this point, if you're not too sure about this, go back and have a look at the videos. For your exam, you need to be able to discuss and apply the criteria that must be met before an entity can apply the revenue recognition model to the contract. You need to be able to discuss and apply a 5-step model which relates to revenue earned from a contract with a customer. And all of this is covered in financial reporting. So now let's have a look at a question. We Buildum Incorporated is one of the largest construction companies in the country. After a lengthy and costly tendering process, the company has been awarded a contract to build 1,000 houses for the local government over the next 4 years. The project will take 3 years and the local government will pay $100,000 per house. The company spends $100,000 in accountancy and legal fees when applying through the local government's tendering process. Each house will cost $60,000 to build and ownership will transfer upon completion of each house. The payment schedule is 7% of the sales price when the project is started, 80% when the project is 90% complete, and the final 13% is payable upon completion of the entire project. If We Buildum Inc. fails to meet their contractual obligations, they will be obliged to pay the local government $100,000. Here's a summary of the project work undertaken from year 1 to 5, payment schedules and the expenses incurred. So how do you record this revenue? If you're staring blankly at the screen, please go back and have a look at financial reporting again. If not, pause the video and please attempt the question. So now that you've attempted the question, let's begin. In this question we can see the project spans many years and that payments received don't match the number of houses built each year, i.e. the company doesn't receive the $100,000 each time a house is finished. So the revenues don't match the performance. So how do we recognise the revenues in the financial statements? IFRS 15 gives us a 5-step model framework. So your first stage is to work through the framework. Step 1. We need to identify the contracts with the customers. So here we know that the contract is with the local government who have commissioned 1,000 houses for $100,000 each. Have the conditions to the contract been met? So is this contract under IFRS 15? So has the contract been approved by the parties to the contract? In this situation we know that they have because the company put in a tender application that is accepted. Has each party's rights in relation to the goods or services to be transferred? Can they be identified? Yes, they have. We know that ownership transfers after completion of each house. Have the payment terms for the goods or services to be transferred identified? Yes, we can see the payment schedule clearly outlined in the question. Has the contract got commercial substance? Yes, it does. The firm expects to make a 40% profit on each house. Is it probable that the consideration to which the entity is entitled to in exchange for the goods or services will be collected? Yes, it is probable. But this is an interesting question because in business it's hard to know if you'll definitely get paid until the money is in your bank account. However, in this question there is a formal contract with a local government which is binding, as the company will be fined $100,000 if they don't meet their contractual obligations. But what if the contract only met some of the requirements to be considered a contract under IFRS 15? So only some of the conditions were satisfied that we already went through. Then the company would monitor the situation year on year, and when the conditions are met and is considered a contract, IFRS 15 will be applied. That's step 1 done. Step 2 is identify the performance obligations in the contract. In this example, it's pretty clear. The company has promised 1,000 houses over the next 4 years. Step 3 is determine the transaction price. Again, in this question, it's pretty clear what a transaction price is. It's $100,000 per house. The transaction price is also called consideration. What if the situation is not clear? What if the local government will pay $120,000 per house if the project is completed in 2 years? Or if, say, house prices go up in 5 years, how would you record this in the accounts? This is also called variable consideration. IFRS 15 limits the variable consideration recognised. It is only included transaction price if, and to the extent that it is highly probable that its inclusion will not result in a significant revenue reversal in the future when the uncertainty has been subsequently resolved. So in our example, a consideration is that $100,000 per house for a 4-year period. If the company can do it in 2 years, it is $120,000. The extent that the extra $20,000 will be recognised is if the project is likely to be completed within the 2 years. Step 4. Allocate the transaction price to the performance obligations in the contracts. In this contract there is only one obligation. Build homes so the transaction price is clearly linked to specific performance obligation. But often it is not as clear because there can be multiple performance obligations. What if the contract included the creation of a public park and sports area for the 1,000 houses? How would that price be allocated? When the contract covers a lot of different obligations, a company can allocate the price to these obligations in the contract by reference to their relevant standalone selling prices. In this example, the company would assess the selling prices of the facility separately. Step 5. Recognize revenue when the company satisfies their performance obligation. Now in this project, we know that control of the house passes when the house is completed and the local government has full control. So that is when the revenue should be recognised, not on year 4 when the project officially is completed. Now what about the costs to obtain the tender? They are also dealt with in IFRS 15. The company spends $100,000 in accountancy and legal fees when applying through the local government's tendering process. From this it looks like the costs are not going to be recoverable and they needed to be incurred if the company's tender was successful or not. Therefore these expenses should be expensed. What if the company expected to recover $100,000? Then they should be recognised as an asset and amortised on a systematic basis consistent with the pattern of transfer of the houses. So now you have applied IFRS 15 and we have gone into a lot of detail because I want you to be very clear in it and we won't want the same level of detail in an exam. Instead, you must be able to apply the standard professionally. So what do we show in the accounts over the next 5 years? In year 0, the consultancy fees of $100,000 are expenses and no income is recognised as no terms of the contract have been satisfied. In year 1, $7 million are received but no houses were built, so this money should not be recognised as revenue. You should consider the significance of time value of money when large amounts are received and if the company is owed by customers for large values of money. However, there is no mention of the cost of finance here. This $7 million should be recognised in the balance sheet's prepaid income. When an asset, liability or receivable is being recognised in relation to this contract, it must be referred to as a contract asset, liability or contract receivable. So when I talk about assets and liabilities created in this scenario, please interpret them as contract assets or contract liabilities, as they only relate to this particular contract. So to recognise the $7 million, we debit the bank $7 million and we credit prepaid income $7 million. This is because until the contract is satisfied, the company owes the local government $7 million worth of services. The company also purchased $18 million of building materials. At year end, there are no houses complete, so the materials cannot be expensed. They are either stock or work in progress. Therefore, they are recognised accordingly. Debit work in progress or stock $18 million. Credit building materials expense bank $18 million. So in year one, no revenue has been recognised and no expense have been recognised. It is all recognised in the balance sheet or the statement of financial position. In year two, 550 houses were completed. Since the local government gets the benefit and use out of the asset as soon as building is complete, revenue is due. The revenue to be recognised is 550 multiplied by $100,000 or $55 million. In the accounts, we do the following. Credit revenue, $55 million. Debit prepaid income, $7 million. Remember, the $7 million that received in year one can now be seen the company has provided the $7 million worth of goods or houses. Debit debtors, $48 million. But what about the expenses? It costs $60,000 to build each house. So $60,000 multiplied by 550 is $33 million, and this should be recognised in costs. So we debit expenses, $33 million, and credit stocks or work in progress, $33 million. We also know that $30 million was spent on building materials in year two. So the stock figure in the statement of financial position would be, year one it was $18 million, plus year two of $30 million, which gives you $48 million, less year two expenses of $33 million, and the stock figure is now $15 million. In year three, 350 houses are built, so that means $35 million revenue needs to be recognised. Crediting revenue of $35 million and debiting debtors of $35 million. Now also, $80 million was received from the local government. This is recognised as follows. Debit the bank, $80 million, and credit debtors with $80 million. The balance of the debtors in the statement of financial position at the end of year three is year two debtors of $48 million, year three debtors $35 million, total is $83 million. Taking away the $80 million that you have received, and the balance is $3 million. And as for the expenses, it's $60,000 multiplied by 350, which is $21 million of expenses. That means we debit expenses of $21 million and credit stocks or work in progress by $21 million. $11 million worth of building materials was bought, so the stock in the statement of financial performance is the year two stocks figure of $15 million, year three purchases of $11 million. That gives you a total of $26 million, less the year three expense of $21 million. Then stocks of $5 million should now be included in the statement of financial position. Year 4 is the final year of the project, and 100 houses are built, so revenue of $10 million are recognised. The company receives its final payment of $13 million from the local government and spent $1 million on building materials. The revenue is recognised as crediting revenue of $10 million, debiting debtors of $10 million. The payment from the local government is debiting your bank of $13 million and crediting debtors of $13 million. And expenses of $6 million are debiting expenses and crediting stocks and work in progress. At the end of year 4, there is no balance in the stock or debtors. There is a financial presentation, but as we talked about in earlier videos, disclosures and financial statements are becoming very important, and your exam must be able to draft the relevant disclosures. So now, pause the video again and draft disclosures from year 1 to 4. Okay, so now you've tried out yourself, let's go through the solution. From year 1 to 4, the disclosure should detail the customer and the contract. Therefore, it will say something like, in year X, we Buildum Inc. entered into a contract with the local government to build 1,000 new buildings. The total value of the contract is $100 million, payable over 4 years. The project is expected in year X. Each year the disclosure should include any assets recognised from the cost to obtain or fulfil a contract with a customer. It can also state the stage of completion of the project, all of which you know from your calculations earlier. The purpose of the disclosure under IFRS 15 is for the business to disclose enough information for users to understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customers. You should know by now that practicing these questions is key to passing your exams. So practice applying IFRS 15 and other standards that are assumed knowledge. You'll see from certain exam questions that there are numerous standards examined in one scenario, and you must be aware of this. Always ask yourself the question, what would you do if this was your client or your company? Thank you.